Hello, everybody, and welcome to the latest edition of Legal Bites, the official podcast of Cummings and Cummings Law, where our primary focus is on assisting businesses and their owners to redomesticate out of volatile legal and tax environments like Massachusetts to predictable pro entrepreneurship, pro growth jurisdictions like Florida and Texas. Today, I am reviewing a recent report in the Boston Business Journal entitled Massachusetts Loses $4.18 billion in income as young workers leave. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and a certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications spanning accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. $4,180,000,000. That is the amount of adjusted gross income that left the Commonwealth of Massachusetts in a single year, according to IRS data analyzed by the Pioneer Institute and reported by the Boston Business Journal in March 2026. That figure represents 2023 data, the most recent we have access to, and it is larger than the $3.9 billion in AGI that left the state in 2022, even though the raw number of out migrants dropped from just over 24,000 to just over 16,000 during that same time period. Fewer people left, but the people who left were wealthier. There is some information value there, wouldn't you say? The out migrants from Massachusetts had higher average income than those leaving any other state in the union, including, very tellingly, California. The Pioneer Institute attributes this outmigration to a specific policy decision, which we have covered in earlier episodes of Legal Bites, that being the 4% surtax on income over $1 million, commonly referred to as the millionaire's tax, combined with Massachusetts estate tax. The surtax was enacted by ballot measure and took effect for tax year 2023. It raised the effective top individual income tax rate in Massachusetts from 5% to 9% on income exceeding $1 million. That is not a rounding error. That is a serious adjustment. In fact, that is an 80% increase, 80%, not 8% increase in the rate applied to income above that threshold. For a business owner with an LLC or subchapter S corporation generating $2 million in pass-through income, the surtax adds $40,000 per year in state income tax that did not exist the year before. That's a new car every year. Maybe not a Maserati, but still. And of course, over a decade, that's $400,000, which is not a bad house in many parts of the country, in additional state tax on a single revenue stream. The demographic data is where the story becomes really interesting. The largest portion of filers leaving Massachusetts were in the 26 to 35 age range, more than 5 times the net loss recorded in that age group a decade earlier. The executive director of the Pioneer Institute noted that while this group did not constitute the majority of outmigrants, the 26 to 35 cohort included a disproportionate share of high earners and highly educated individuals compared to other age groups. Massachusetts has historically been known as the most educated state in the union. Maybe that's starting to change. These are not retirees cashing out. These are professionals and tech startups and SaaS ventures and the owners of these entities in the early to mid stages of their careers, making location decisions that will determine where they pay taxes, build businesses, where they raise families, for the next 30 or 40 years. When a state loses that demographic at 5 times the historical rate, it's not just losing a year of tax revenue, it's losing a generation of tax revenue. The pre-retirement cohort tells the other half of this story. Out-migrants between 54 and 65 years of age took $1.3 billion in AGI with them, despite only about 3,300 filers being in that group. And that is an average of nearly $400,000 in AGI per filer. These are business owners, partners, and senior professionals who are relocating before retirement to establish domicile in a state that does not impose income tax on retirement distributions, investment income, or proceeds from the eventual sale of their closely held business. Massachusetts also has an estate tax with a very low threshold of $2 million. In fact, one of the lowest in the nation. Compare that to the federal threshold of $15 million for an individual. Florida has no estate tax. Texas has no estate tax. Florida has no personal income tax. Texas also has no personal income tax. The math is clear and unambiguous, and the IRS data confirm that people are acting on it with rationality and all due haste. The majority of the AGI that left the Bay State went to 2 jurisdictions, Florida and New Hampshire, interestingly enough, although Texas was certainly in the mix as well, which together absorbed about just below $3 billion, accounting for 2/3 of the total loss, give or take. These, again, are states that impose no individual income tax. The Massachusetts Budget Policy Center, which supports the surtax, offered a counterargument. Kurt Wise, a senior tax policy analyst, stated that measuring AGI can make outmigration look like lost economic activity. Well, it is. But according to him, the reality is more complex, okay? He argued that when someone leaves a job, the job stays in the state. That's not true in many cases. And when someone sells a business, the customers remain. Well, that might be true, but from what I've seen, a lot of the customers are leaving Massachusetts as well. And that's my firsthand experience in my practice of law. But to stick with his argument for a minute, according to this analyst, another dentist or another hardware store will fill the gap. Again, I don't think that's reality, but we're all entitled to our opinion. He also noted that 9 out of 10 filers who left the state earned under $200,000 per year, and that those households were more concerned with affordability of housing, childcare, education, and healthcare than taxes on millionaires. I don't think he intended to do this, but he's actually just bolstering the argument to leave the Commonwealth for another state. But again, that's my color commentary on his analysis, which you are welcome to seek out for yourself. That argument may have some merit for the lower income out-migrants, but it does not address the $4.18 billion figure, which is driven by the small number of high AGI filers at the top end of the range. The 9 out of 10 filers earning under $200,000 contribute a fraction of the lost AGI. However, the damage is concentrated in the 1 out of 10 who earned more. And the argument that a job stays when the person leaves assumes that the business stays, which again is the opposite of what we are seeing in my law practice. For a pass-through entity where the owner is the business, the owner's departure is the departure of the business. The LLC or the subchapter S entity goes with them. The pass-through income, the payroll, the vendor contracts, and the local spending all follow the owner to the destination state. And this is where the second order effect that analysis does not capture becomes so clear. When a business owner with $2 million in pass-through income departs Massachusetts for, say, Florida, the state does not just lose the income tax on that $2 million. It also loses the payroll taxes generated by that business's employees. It loses the sales tax revenue generated by that business's spending. It loses the property tax revenue from the commercial lease. It loses the income tax paid by employees who, in many cases, follow the business owner to the new state or lose their job altogether when the business relocates. That $4.18 billion in lost AGI is just the first line item on a much more complex analysis, and the total economic impact over a period of time is a multiple, if not an order of magnitude greater than that figure. For the Massachusetts small or medium-sized business owner watching this data, the relevant question is not whether the state's tax environment is driving people out. The IRS data has already answered that question for us. The relevant question instead is how to move the company without losing the value that has been created. And in many answers, for many people, I should say, that answer is redomestication. Redomestication is the legal process of transferring the home state of an existing LLC, corporation, or partnership from Massachusetts to another state without dissolving the company, without forming a new entity, and without triggering federal income tax. Now, I speak with a lot of attorneys and CPAs who start arguing with me about this. All I can say is look at our track record. We have redomesticated a number of companies, large and small, out of Massachusetts with a 100% success rate. The statutory framework is there, the case law is there. A lot of people just don't know that this option even exists. Under redomestication, as I said, the company that exists after the redomestication is the same legal entity that existed before. The federal employer identification number carries forward. Its contracts remain in full force and effect. Its bank accounts, credit history, and vendor relationships continue without operational or financial disruption. Under the Federal Internal Revenue Code and applicable Treasury regulations, and when executed in strict conformity with the statutory requirements of both Massachusetts and the destination state, redomestication is a non-taxable event at both the entity and owner level. Now, let's talk about some of the alternatives, and I use the word alternative loosely because these really are not alternatives at all in most cases. Dissolution, sometimes conflated with termination, but we'll allow the conflation for purposes of simplicity in this video, kills the company, eliminates the federal employer identification number, and often triggers a taxable event. Foreign entity registration, which a lot of CPAs and even many attorneys seem to recommend, only keeps the company domiciled in Massachusetts, meaning the owner continues to pay the taxes in that jurisdiction, continues to file the returns, and really gains nothing except more paperwork. And in some cases, an old school traditional merger might still make sense, whereby a new entity is created in the destination state, but this often requires a new federal employer identification number and can trigger tax at the state and federal level, particularly when it is handled incorrectly. The Federal Internal Revenue Service is scheduled to release similar migration data pertaining to 2024 in June. That data will capture the full second year of the effect of the surtax. If this trajectory holds, and certainly anecdotally, I can tell you that it is holding based upon the matters I've handled myself, the outflow will be larger, not smaller, because the tax planning decisions made in 2023 take 12 to 18 months to execute. And those departures will appear in 2024 and subsequently 2025 data and beyond. The window to act, if you are in this situation, is before the new tax year begins, not after. If you have questions regarding redomesticating your existing LLC or corporation, please use the link in the description for more information on this process and to schedule time for us to speak about your specific situation. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature and it is not legal advice because legal advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on this topic and related topics, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. And I look forward to that opportunity to speak with and perhaps even work with you very soon.